Everybody always talks about investing, but nobody actually shows you how to do it. Well, today I am going to change that for you. I am going to give you a crash course on investing and teach you step by step how you can get started. Who am I to teach you about this? Investing helped me go from making $50,000 a year to becoming a millionaire at the age of 30. And hands down, I believe that this is the best way for 99% of people to build their wealth. And that is because you don't need a lot of money to start. Investing is quite literally how you turn small amounts of money into big amounts of money over time. It's not for the rich, it's how you get rich. And I don't know if you know this, but it doesn't take a lot of time to manage either. Once your investments are set up, you'll spend maybe an hour a year managing them. Ultimately, it's just passive income. When people talk about investing, they are talking about buying stocks. And the process to make money in the stock market is actually really simple. But a lot of people lose money because they think they can outsmart the market. So we all know who Warren Buffett is, right? World famous investor, multi-billionaire. He made a $1 million bet to Wall Street saying that their best hedge fund managers couldn't beat what the market could just do passively. And guess what? He was right. The market returns an average of 10% a year. If people who trade stocks all day cannot reliably beat that, don't fall into the trap of thinking that you can. This is how people lose money. So when you start investing, you're not going to trade stocks, you're not going to pick stocks, and you're not going to invest money that you need in the next 5 years. The market is volatile in the short term, meaning these prices, they're going to go up and down a lot, which means the value of your portfolio or how much money you're seeing in your brokerage account is going to go up and down a lot in the short term. This is normal. Crashes and corrections happen on average once every 2 years. The key here is to not get emotional. Good investors are not emotional. And remember that you still own the same number of stocks. The price has just changed for a moment in time. Those little ups and downs become nothing more than blips on the map because over time, the market as a whole has always gone up. Now, 2 things that can seriously derail your investment results are going to be high fees and having the wrong asset allocation. Investment fees of 2 to 3% to an advisor or for mutual funds may seem small, but someone who does that will have to save and invest double that of somebody who invests on their own to end up with the same amount. Good investors minimize fees. And then that bad choice to pay that 1%, 2%, 3% fee is compounded when you have the wrong asset allocation, meaning you do not have the right percentage of stocks versus bonds in your portfolio for your age. I see this problem all the time. Bonds typically return a lower amount than stocks. So let's say you were in your 20s and you were scared. You went into your financial advisor and instead of explaining to you how investing works, they just put you in a conservative portfolio. Maybe that portfolio has an average return of 5%. And then let's say you're paying 2.5% in fees to a financial advisor or for these mutual funds. This means at most, you can make 2.5%. You would have been better off putting your money in a high yield savings account. You literally would have made more. The only person that gets rich when you do that is the bank. Now, to buy your first investment, what you're going to do is open an account with a company called a stock brokerage. They're going to be the ones that give you access to the stock market. Once you have your profile set up with this brokerage, you are going to open up an account. This account is going to be what you put money in to buy investments with. The account you choose is going to be the one where you pay the least amount of tax possible for your specific goal and your personal financial situation. Some accounts allow you to grow your wealth tax-free, and other ones are taxable, but you get a tax write-off for contributions that you make, meaning money you put into that account, you get to write off on your taxes. Then you are going to actually fund that account. Link your bank account to this new stock brokerage account, transfer money into the account, and once the money is in the account, you are going to use it to buy investments. Remember, the account is not an investment. A Roth IRA, a TFSA, an RSP, a 401k, those are not investments. That is the house that you put money in and then you buy investments within it. What investments do you buy? I would do something like a 3-fund portfolio where you have a US index, an international index, and a bond index. Or to simplify the process, you could do an asset allocation fund or a target date fund. Don't do mutual funds. Then you are going to automate your contributions, meaning you're setting up an automatic transfer every time you get paid from your bank account to that brokerage account, and you're using it to continue to buy investments. You're going to turn on something called DRIP, Dividend Reinvestment Program, so that every time you get paid out a dividend, you use that to buy more shares of that investment. That will help compound your growth. Then you sit back and the market will do the rest. Now, obviously, there's only so much that I can say in 5 minutes, but I have a 90-minute investing masterclass. If you guys have not taken it yet, it is incredible. It's on my website under freebies.